good afternoon, everyone. My name is Li Chye, Financial Market Analyst from Beyond Insights. Today's topic will be market update, focus on monthly recap and actionable insights. As we know that the month of May was a bullish month, and we have arranged this session to have a 15-minute quick monthly recap of highlight of the month and look at what are the opportunities ahead and what are the risks we need to take care of and what are the items that are actionable. As usual, the market is dynamic. Whatever we share here today is based on the current development. Things may change if there is further development. Do you agree? Okay, just an important note before we start. We want to make sure that you know we are not licensed investment advisor and we do not manage customers' fund. We are an educational institution. Our purpose here is to educate people so that you can make your own decisions and be your own investment manager. That way, you have better control over your decision and hence be able to get better results. If you are looking for stock tips, this is not the place for you. All the information we share here are meant for educational purposes only and must not be taken as a recommendation to buy or sell. Let's start. Let's have a quick recap on key highlights for the month of May. Market highlights for month of May. S&P 500 actually break above the 2023 high. Let me show you the chart. This is the SPY chart, which is the ETF that track the S&P 500. If you take a look on the year-to-date performance, which is 2023 only, is now at the high of the year. If you take a look on the one-year charts, it's approaching the one-year high as well. And next, let's move on to the Nasdaq 100, which track all the tech stocks. For the Nasdaq 100, it has been very bullish during the month of May with a lot of strong technology stocks earnings. Nasdaq 100 continue its uptrend and breaking the one-year high. If you go to the charts itself, the stock chart, let me show you QQQ, which is the Nasdaq 100 related ETF. If you look at the one-year performance, it actually reversed into an uptrend during early of the year, around February, and now is breaking above the one-year high, recent one-year high. If you take a look on the recent downtrend, it's already approaching, it already recovered more than half of the previous downtrend. Why the stock market was so bullish during the month of May, which are the current month, which we are approaching the end of month now. Let's take a look on what actually contribute or what is potentially contribute to the recent market rally. If you take a look on the central bank decision, central banks has been slowing down the pace of rate hikes over the past months. Recently, the Fed, which is the US Central Bank, the Federal Reserve, increased the interest rate by 0.25%. And this was followed by ECB, which also known as European Central Bank, also increased by 0.25%, which in line with what the Fed does. And Bank of England as well increased the interest rate by 0.25%. The less aggressive central bank action actually fueled the rally, partly fueled the rally for the month of May. And next, we have the trending down inflation in the US. As we know, in 2022, the stock market was in a downtrend due to the spiking inflation, the high inflation environment, and Fed has been aggressively increased the interest rate. However, for 2023, inflation has been trending down. Inflation has been trending down over the past 10 months. Past 10 months, inflation has been trending down. And this also, with the trending down inflation, it also increased the probability of the Fed pausing interest rate hike in coming June FOMC, which is a meeting that usually decide the interest rates. Currently, markets are very optimistic about potentially Fed may pause the interest rate hike in month of June with the trending down inflation as a backup data, which means that the previous effort from the Fed that increased the interest rate has been showing its result. The inflation has been coming down. There is a potential action where Fed may pause the interest rate hike. However, the coming CPI data or the inflation data still will be crucial, and we may need to monitor the upcoming Fed action, whether they are pausing the interest rate hike or they will continue the interest rate hike. With the trending down inflation, do you think that which one is high likelihood to happen? Whether Fed will pause the interest rate hike or Fed will continue to aggressively increase the interest rate? You may type in the chat for that. And with the anticipation of potential pause of rate hike, the stock market has been in a risk-on mode environment since early May. So what I mean by risk on mode, risk on means when investors are taking more higher risk investment compared to risk off mode, where they will go to more conservative asset like cash. So now the market is in a risk on mode, means that funds are actually buying into higher risk assets such as the stock market. So this stock market rally has been fueled mainly by the technology stocks led by software company like Microsoft, semiconductor company like AMD or Nvidia, and communication sectors company like Google or Meta. So with all the key highlights covered and the recent market rally, is the rally able to sustain? You may answer me in the chat whether the rally able to sustain or not. And what are the potential opportunities ahead that we can capitalize on still, because the rally, just an initial part of the rally, as I showed you in the chart earlier, is still recover halfway from the 2022 high, and there is still potential opportunities ahead. And what are the risks that we need to take care of in case there is something happen? What are the risks we need to take care of? So before we go into the risks, let's take a look on the opportunities first. Okay, so there are still plenty of opportunities out there in the stock market. For example, the one of the important key point will be industries with themes. For example, AI, artificial intelligence. So with the rise of generative AI, such as the ChatGPT or Google Bard. So since I mentioned about ChatGPT, so any one of you have used ChatGPT before, you may type in the chat as well, whether you heard about ChatGPT before. So all this ChatGPT and also Google Bard is another way, another AI, generative AI from Google, which are similar with ChatGPT. So with the rise of generative AI, actually it fueled the companies that are having involved in the AI industries. For example, AMD, Nvidia on the hardware side that are producing high-end chips to actually power all this AI research, and also direct involvement company like Microsoft and also Google. So you can see that over the month of May or over the quarter, all these companies that involved in AI or with strong industry teams has been rallied quite a lot. So next, other than AI, we also have PC demand recovery. So for the PC demand recovery, as we know, during pandemic in 2020, there is a spike in PC demand. People are buying more PC or laptops as there were lockdown and people were working from home. People will study from home. So the PC demand has been spiking up in 2020. However, it has been weakening. The demand has been weakening over the past 3 years. 2021, 2022, and early 2023 has been weakening the demand. This is due to previously those people that want to buy laptop already buy them in 2020. However, what is the usual cycle you think that people will replace their laptop or even smartphone or even their electronics device? What is the typical replace cycle or upgrade cycle? So you may type in the chat, what is the typical upgrade cycle? How many years? So as we know, usual replacement cycle will be around 3 to 5 years. Just like your laptop, if let's say a 5 years laptop, usually it will start to be lagging if let's say you are using the latest software, or you will start to slow down or start to have problem. So people tend to upgrade their laptops or even PC every 3 to 5 years. So in this case, we are approaching the upgrade cycle now. 2020 is one of the cycle that people are upgrading their PC. So now we are approaching 2024, which is a 4-year cycle. So with this, there is expectation that the PC demand will recover in 2024. So as usual, the stock market is 6 to 9 months ahead of the economy situations, or this theory also applies in the industry level. So when there are forecasts of PC demand going to pick up, the inventory for semiconductor going to clear in quarter 4, 2023, and the recovery will come in 2024. So this will benefit the semiconductor stocks. And these two industry teams, the AI and also the PC demand recovery, has been fueling the technology sector rally over the past few months. I can show you a few charts. So company like, let's say Nvidia, has been rallying and actually already break above all-time high after the strong earnings. And this has been mainly fueled by the rise of generative AI that requires a lot of Nvidia chips to research or train the AI or power the AI research. And other than that, AMD, which is also in a similar industry that producing AI chips and also high-end computing chips, are actually recovering as well. So from here, we can see that even though Nvidia already made new high, there is still plenty of opportunities that you can search for in the similar industry. However, whatever I share here is not a signal for you to immediately buy the stock, or it's a buy signal. As I mentioned earlier, we are just whatever we share is just educational purpose, and you need to have a systematic way and also a proper risk management way in order to capitalize on these opportunities. So let's take a look on a few more charts as well. So let's take a look on Microsoft. So Microsoft is a software company, and they are one of the generative AI company that involved in generative AI. So you can see it also recovers strongly from the downtrend over the recent months catalyst. So a reminder, make sure that if let's say you want to take care of this opportunity, capitalize on these opportunities, you may need to have to learn up a systematic way and also a proper risk management, because we need to have a right way to invest in the stock market to be a responsible investor. So other than industry with key themes like AI, PC demand recovery, companies with low debt, low exposure to bonds, and strong cash flow also will have an advantage during this environment, because the interest rate has been going up since last year, and now we are at 5.25%, based on the last FOMC meeting. So even though there are expectations that Fed going to pause the interest rate hike, so do you think that they will immediately cut the interest rate? You may answer me in the chat. So no, which is unlikely they will cut the interest rate immediately. So we are expecting the interest rate may be stagnant at 5.25% for some times. And company with low debt, low exposure to bonds, and strong cash flow will have an advantage during this high interest rate environment, because since they have low debt, they don't need to pay much interest rate. And if let's say they have low exposure to bonds, they will have lesser bond risk. And with strong cash flow, they're able to withstand the high interest rate. This contrasts with companies that with high debt, high exposure to bonds, and weak cash flow, they will go bust if let's say they're not able to pay up their loans. And if let's say they have too much losses in their bonds investment, they will go bust as well. So the opportunities lies within the companies with low debt, low exposure to bonds, and with strong cash flow. And opportunities number 3 will be companies with a low risk of weaker USD. So as we know, overall, the market has been expecting the Fed to slow down the interest rate hike. And relatively to other regions like Europe and also UK, US already have a lower inflation. Inflation has been trending down. However, in the UK and also the Europe, inflation are still high, even though they are trending down. So there are expectations that the European Central Bank and also the Bank of England will have more rate hike cycle compared to the US Fed, which is the US Central Bank. So with that, people are expecting a slightly weaker US dollars. However, the US dollars relative strength, or the strength of the US dollars against ringgit, which is Malaysian ringgit are still weakening against the US dollars. So why I say companies with a low risk of weaker USD will have an advantage when the USD are weakening. This is because if let's say the company, okay, so what are the low risk company that having a weaker low risk company? For that is those company that having a higher foreign revenue exposure. For example, those company that exports more of the products and taking revenue from other country. So with a weaker USD, they can actually, with a weaker US dollars, they can actually have a better revenue, because a strong US dollars may impact their revenue report. So companies like Microsoft, Apple still will have an advantage because their revenue exposure are quite balanced. Like for example, Microsoft have a half of revenue exposure, foreign revenue exposure, and half of them are local revenue exposure. So Microsoft are quite balanced. And also other company like Apple having high foreign exposure, like they are selling iPhones quite well in China and other Asia region. So this company will have a lower risk of weaker USD compared to other companies that are relies on a lot of other import or other sources. So next, let's take a look on the risk to the market. What is the potential risk ahead of us? So with the prolonged high interest rate environment, number 1 will be the housing market risk. So this will mainly on the property investor. If let's say during a low interest rate environment, a property investor may take up multiple loans to buy up multiple houses, and they are rely on the rental to actually break even on their investment or gain money from the pricing difference between the loan payments and also the rental rate or the rental income. However, during high interest rate environment, do you think that they need to pay more interest? Because during high interest rate environment, the loan may get more expensive, and they may need to pay more for the interest with the loan they are taking up for multiple property investment compared to the low interest rate environment. And the rental will be a crucial part. So if let's say economy slow down, the rental also coming down, then it will generate housing market risk as more and more property investors couldn't pay off their loan. And also number two will be the bond market risk. This is due to the low interest rate transitioning of low interest rate environment to high interest rate environment. So as we know, for the bond market in the past, during low interest rate environment, those bonds that purchased by the company will have less attractive pricing or demand compared to the latest bond that having a higher yield due to high interest rate environment. So all these companies that invested in these previous bonds may suffering unrealized losses. This is due to the newer bond is having much more demand. So this already happened in some of the banks like the SVB bank in the past. So those companies that holding a lot of this bond investment will be a high risk. So as I mentioned earlier, low exposure to bonds for opportunities and high exposure to bonds will be the risk. So avoid those companies that having a lot of bond investment, especially those high exposure to the bonds market. And risk number two will be geopolitical tension. So as we know, the US-China tension are still there, which is a norm nowadays. So we just need to select the right industries and use the right instruments to take care of the volatility or the right trading style to handle the volatility. So the US-China tension will be still there. The chip war, the tech war, the Taiwan issue will be still there. And next will be the potential strike on Iran by Israel. So this is just based on the recent, we can see that there are some shadow war between Israel and Iran in the Syrian region. However, if there is a Middle East tension, then this is the risk we need to take care of. One of the things you can do is to whether to diversify some of your portfolio to the energy sector if there is further development in the Middle East. And lastly, it will be the slowdown in consumer spending. So there is a potential economic slowdown in Q4 2023. So this will impact the consumer spending. So people are expecting the consumer spending to be slowed down. This is also one of the reasons why you can see from the chart that consumer discretionary stock are slower to recover. For example, Nike has been slower to recover compared to all these tech stocks. So that because of the expectation of slowdown in economy in Q4 2023. Hence, the consumer discretionary sector will be recover slower. However, this could be an opportunity as well, because after the tech stocks rally, we can see that usually the market will be ahead of 6 to 9 months ahead of the current situation. So if let's say I said 6 to 9 months ahead and people are expecting a recovery next year, expecting an economy recover next year in 2024 as well. So likely second half of this year, you may able to monitor whether the consumer discretionary market are recovering and whether the retail sales data, consumer spending data are recovering as well. So in summary, despite all the bad news you heard out there, for example, the bank collapse, the Ukraine war, US sending more weapons, and people talking about the debt ceilings that US may default and all this, the market continues to go up. So what does this mean? This means that money in the sidelines, all the funds, all the hedge funds, all the retirement funds, may be taking the opportunity to get back into the stock market when the bad news occurs. So currently, based on the chart that I showed you earlier, the overall market has been reversed into an uptrend. And coupled with the expected debt ceiling resolution, and also people are expecting the economy to recover next year, the stock market rally likely will continue. So a dip or a pullback is an opportunity for you to look out for good investment. However, this is not applied to all stocks. Like I mentioned earlier, you need to selectively select the limited stock in the certain sectors. For example, the industry with themes I told you, like evolved AI, PC demand recovery, or those companies with low debt or strong cash flow. So with that, we can see that the uptrend may be continue and there are still plenty of opportunities ahead of us with some risk to take care of course. So it will be a good time for you to equip yourself with right knowledge to capitalize on the upcoming opportunity. Like I mentioned earlier, consumer discretionary might be the next opportunity or the continuation of the uptrend for all these technology stocks that involve in AI, because the demand and growth is still high, and also potential PC demand recovery next year. So you can see that there is still plenty of opportunities in the market, and any pullback will be a good opportunities to catch some good investment or take up some good investment position. However, all of these opportunities may need to take care of with a proper, systematic way approach, a versatile way of approach, and a safe way of risk management. So with that, that's coming to the end of my presentation. So I will take a pause here to take a few Q&A. So any questions you may type in the chat.
Li Chye, we have one question from SF. where he's asking, I believe, is what are the longer term risks with the continuations of the geopolitical tensions between the China nations and the US nation?
Okay, so what are the longer term risks? So in the long term, so I cannot know the future, but however, with the geopolitical tension going on, what you need to do is to this I think it will not go away for the coming 3 to 5 years. However, if let's say you however, people are talking about the dollar, all this, right? The US dollars, everything. So just to reassure is that the US has been the largest consumer market. So in order for China to take over the currency and everything is it take a long time, and also China and US has been involved in a lot of trade deals. They has been rely on each other. US has been the largest consumer market, and China will be US is China's largest exports over the years. So with the tension, although the tension is been going on, there might be resolution, and at the same time, you may need to select the right sector. The investment in the US stock markets over the next 3 to 5 years will still generate greater returns if you stay in cash. And also with the geopolitical tension, hopefully they will have some resolution. But I would say in a very long term, we cannot see the future. But next 3 to 5 years, I would say even the tech, like for example, the chip war, everything, the market has mostly factored in the risk already. That's why you see the people are buying semiconductor stocks when there are bad news. Like for example, the Micron, China sanctioned Micron. People are taking this opportunity to get into the semiconductor sectors because people are expecting a recovery next year, and US still the biggest consumer market, and people are actually next 3 to 5 years, I would say things will be will not go too bad. I mean, you may need to selectively select good companies with less China exposure. For example, just avoid the China stocks which highly influenced by the government, or those companies that with very, very high exposure in China. Any further question?
There's no more questions in the session.
Oh, okay. So so with that, so I would like to invite you to our upcoming free 3 hours webinar that cover a framework on a systematic, versatile and safe way approach to invest in the stock market. So if you are interested, you may scan the QR code and register and grab your free spot now.
All right. Thank you, everyone. We'll be closing the sessions. Have a great day ahead. Bye-bye.
Okay, great days. Bye-bye.